makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Zurich with the conversations that matter, and here's what's coming up on today's program. UBS falls after earnings disappoint investors, while the Swiss bank says it will resume share buybacks this year, vowing to hand as much as $1 billion to shareholders in the second half. We'll bring you our interview with the chief executive, Sergio Ermotti.
One thing that we need to do is to be willing in the next couple of years to sacrifice a little bit of top-line growth in order to improve the returns on our financial resources, particularly on the balance sheet.
BP rallies after accelerating share buybacks as its new boss aims to woo investors while sticking to the company's clean energy strategy. Plus, Chinese markets soar amid promise of more support from Beijing. President Xi is said to be briefed on the country's stock slump. Now let's take a look at the European markets map. Now, if you look at the general mood, I think it's being bolstered, and we're seeing a little bit of gains across the board. European stocks actually rising, bolstered by strong results from BP. Again, if you look at the global bond market, it's been a pretty eventful, I would say, 4 or 5 days. It seems to be a little bit steady now after the biggest 2-day sell-off in months. I look at Chinese markets, they're now closed, but again, there was a bit of signals about a possible economic recovery. And then a couple of other things we're watching out for. Again, UBS posting this net loss. Infineon Technology actually guided for lower than expected revenue this year as a German chip maker is hit by a broad slump in semiconductor demand. And then, of course, watch for BP. So we were just saying UBS shares lower after the Swiss bank missed estimates in the fourth quarter as it tries to move beyond the integration of Credit Suisse. Now, the negative reaction comes despite a better than expected dividend. In a wide-ranging interview, the chief executive, Sergio Ermotti, also told me about his plans to raise cost-saving targets by 2026.
It's a pivotal year because if you think about the journey, the first 6 months are very intense. I think we're going to go through the merger of the two operating entity, UBS and Credit Suisse AG, will merge in the first half of the year. The subsidiaries in the US and Switzerland will merge also during 2024. So this is the prerequisite to be able to realize our synergies. We already achieved 4 billion of cost savings, exit rate 2023. We now plan to have another gross savings of 9 billion between 2024 and 2026. Partially, this will be reinvested in the business to make our platform more resilient and up to speed with the requirements, but also to invest in our future.
So, Sergio, how important was this investor update just to give a blueprint of the kind of growth that you want to attain and how?
I think it's very important for investors to understand how we are connecting the dots between what we said in summer last year and in respect of our long-term plans, in 2026 plans and going beyond that. So today we are providing few dots between 2024 and 2026, how we achieve cost savings, how we manage our balance sheet, how we want to manage growth that has to come in a sustainable way.
Now let's bring in Bloomberg's managing editor for finance and investing in EMEA, Tom Metcalf. So, Tom, if you look at the investor reaction, there was a little bit of questions right at the start on whether investors would focus on the positives or the negatives. What stood out for you?
Yeah, it's really interesting. For me, it was that return of the buyback, for one, and that sort of higher than expected cost savings. They're now targeting $13 billion. So, my read on this was, it's continuing to say the integration is going to plan. It's going to be a tough integration, but it's looking positive. I think it's interesting that, underlying business, that perhaps a little bit disappointing there. And that's what, whether your glass is half full or empty is kind of probably how you're going to view these results.
Yeah, and Tom, it was interesting. So when I spoke to Ermotti earlier on, I asked him how important 2024 was. And he says, look, it's a pivotal year. If you look at some of the liabilities, how much do they need to deliver the integration of Credit Suisse in the first 6 months?
Yeah, I mean, pivotal absolutely captures it. And I think he had a lovely line on the Analyst call just now saying, in terms of deliverables, he's got to focus on, there's something like 6,000 for the next 3 years. So that gives you a sense of just how complex it is and how many things could potentially go wrong. And that's probably why I think, as that sort of awareness seeps into perhaps shareholders, they are aware there is some downside here. And of course, against the context of UBS shares up something like a quarter in the last 12 months. That's a really impressive growth, and I suspect there's probably a bit of profit taken today as well.
Yeah, and the million-dollar question is, can you actually have an EU bank valued as a U.S. bank? And certainly that's what the shareholder activist wants to see from UBS. I mean, what kind of growth do they need to deliver on to make sure that actually they're valued like a Morgan Stanley or even a JP Morgan? Is that even possible?
Well, what Sevian came out and said, look, post-integration, come like 2026, we can see a pathway to UBS having, I think, a return on tangible equity north of 20%. I have 25% in my head, which would be enormous, and that would be very un-European bank-like, I suppose. And that's the thing. There's always been this big disconnect between European banks, and is UBS able to bridge that gap? That's the big question, as you say. And certainly, if Ermotti is able to pull that off, it will be a completely transformed banking as we know it.
That's really funny. Very un-European. Tom, thank you so much. Tom Metcalf there with the very latest on some of the banking landscape. Now, we'll bring you, of course, our full interview with the UBS Chief Executive, Sergio Ermotti. That's a little bit later this hour. Now, we're also joined by Sanlam's Global Equity Investment Analyst, Hannah Gooch-Peters, and Bloomberg's Justina Lee. So thank you both for joining us. Hannah, when you look at, first of all, the bond market, I mean, they've had a wild ride over the last couple of days. Finally, a little bit of stabilization. Are you any closer to understanding what monetary policy from the Fed looks like?
I think that what we're going to see is that if we look firstly at the equity market, I think the equity market is telling us that that rates are going to come down a lot sooner than they perhaps will. I think we've had a lot of very clear sort of dictation from the Federal Reserve saying that they're going to wait for those inflation numbers to come back to that 2% target. So I think we're seeing a lot of volatility in the fixed income market, just around the news, around a bit of uncertainty. But I think that if we look through to the equity market, what that's actually telling us is that rate expectations were looking to come down much sooner than they actually are, and then we might see just a period of sort of moderation now while investors digest this.
Justina, what's your take? Again, we also spoke to Sergio Ermotti about this, and he was interesting on the Fed and saying, look, anyone who tells you what they think the Fed inflation does is, I mean, he almost said, we just don't know at this point, which means that you could have a lot of interesting market volatility, which for a bank is either good news if you're on the right side of the trade, or it could be bad news if you get it wrong. How much more volatility, Justina, could we see going forward?
Yeah, I think the extent of the Treasury rout over the last 2 days really tells you how far the market expectations are now adjusting. And I think it's, because of two things, right? One is Fed officials, not just kind of Jerome Powell, but also Neil Kashkari kind of really came out and emphasized that, they would rather almost kind of cut kind of a bit later and make sure that inflation is on a right path and kind of make the opposite mistake. And of course, the other thing is the ISM number kind of really came ahead of expectations, and same with the jobs report last week. So it's not just that the Fed is patient, it's also that the numbers are telling us that this kind of disinflationary path is maybe not going as smoothly as we previously expected.
And Hannah, your investment strategy is actually brilliantly thought out, but extremely difficult to execute because you're looking for high-quality growth companies that are basically mispriced. Where do you see that pocket in the U.S.?
So in the US, of course, we've seen, and I'm not going to talk about the Magnificent Seven because I think it's very, very well publicized, but you've seen this huge bifurcation of returns between the largest companies in the world that have been driving the returns of the equity market over the past, say, year. And those companies that are lagging underneath. And it's tremendous the opportunities that we're starting to see in things like the largest US health insurer, for example, like United Health. And we've seen fantastic returns from other companies outside that, like Intercontinental Exchange, like Fiserv, for example. So I think if you're willing to look underneath those very, very, mega cap companies that are now trading on exceptionally high valuations, you can actually look forward to much better return prospects than perhaps the market over the rest of this year, just because the starting points of those valuations are much better.
Hannah, are you expecting a correction, if not for the Magnificent Seven, for a part of the market that, if not overstretched, it seems to be certainly priced to perfection?
It certainly is, and I think that, certainly parts of it are leaving very, very little margin of safety in terms of valuations. If you've got a pocket of stocks that are trading on sort of between 2 and 3.5% free cash flow yield, then really there is no margin of safety there for those. But I think what you've got is the rest of the market is actually looking much more reasonable in terms of valuation. So I don't think that we'll see a correction. What we might actually see on a headline level is the market trending sideways for some time being now, just while we digest the rest of this year. But I think that what we might see is a bit of a catch-up, particularly from the smaller cap stocks that have lagged so far behind the mega caps that are dominating the global equity markets.
Justina, do you have a main theme actually running through all of these earnings? It does seem, as always, I mean, there's nothing to write home about, that if you have very good earnings and give back substantially to shareholders, a la UniCredit or BP, you're going to do well in this kind of market. Is there anything else that actually, gives us a common point for the companies that are doing well in this kind of environment?
Yeah, it's kind of interesting that, to your point about how hard it is to find high quality growth that's also reasonably priced right now. It's partly because this year there's been a really big bias for, large caps, quality, growth stocks, like everything that investors kind of feel safe with. And I think one theme is definitely, the small cap underperformance. And one kind of trend that a strategist has picked up is, we've kind of seen decent sales growth across large and small, but large caps seem to be better at turning that into kind of also an earnings beat. But I think kind of the debate here is small caps have been lagging for a really long time now, so those valuations are very attractive. And so I think if you're an active stock picker, there's probably more opportunity there if sort of you're sufficiently selective.
Which, Hannah, is what you and your team are trying to do, but how difficult is it to actually impress investors, again, given some of the expectations out there?
I think that investors at the minute are very focused on the short term. There's, very short-term time horizons here. I think particularly given how strong the market was last year. I think that right now, if you're looking to exploit a longer-term time horizon, give a company time for the quality to assert itself, now is actually a really good period of time to be looking at these companies that have got the more compelling valuations, and you are willing to wait, say, 3 to 5 years for those companies to sort of grow into their quality, if you like. So I think it's actually a really exciting point in time if you're looking for companies that are able to sustainably grow their earnings over a long period of time with good balance sheets and, really importantly, sort of high barriers to entry, strong economic moats to those companies. There's a lot of opportunities out there. Like I said, companies like United Health, like Pfizer, has done really, really well. And the exchanges, and there are many others. And I just think that if you are looking to have better return expectations going forward, that time for selectivity is now.
And Hannah, when you look at some of your stock picks, does healthcare actually provide a little bit of a better opportunity than others because it's not one of the sectors that has been the most loved in 2023?
Yeah, so again, there's a huge sort of diversion between sort of performers of like the health insurers, which do come under healthcare, versus something like an Edward Life Sciences, which has had a tremendous move over the past few days on the back of things like some of their products being approved. They're, of course, in a much faster part of the market that is sort of heart valve replacement technology, exceptionally high company, very strong balance sheet. But the market has been very quick to reward sort of those higher quality, higher growth companies. And I think a company like United Health, if you're willing to diversify your healthcare exposure, is still offering 13 to 16% earnings growth, including the impact of share buybacks. And I just think a sort of 5% free cash yield, a company with a moat like this offers a very sort of sustainable path to long-term returns. So it's about that diversification. If you can look at companies with medtech exposure, if you can look at companies with insurance exposure, the things they have in common is the ability to grow their earnings, strong balance sheet, and they are leaders in what they do.
Fabulous. Hannah and Justina both stay with us. Thank you for joining us. Hannah Gooch-Peters there from Sanlam, and of course our Justina Lee from Bloomberg. This is Bloomberg.
It feels like the economy's been quite strong on the growth front. You got big jobs numbers, you got big GDP numbers, better than expected. But at the same time, we've had inflation better than expected, too. If we just keep getting more data like what we have gotten, we're well on the, I believe that we should well be on the path to normalization.
Well, that was the Chicago Fed President, Austin Goolsbee, saying more good data is needed before starting rate cuts. Still with us, a global equity investment analyst at Sanlam, Hannah Gooch-Peters, and Justina Lee of Bloomberg. Hannah, when you look at, so we talk about monetary policy, of course, day in, day out, trying to figure out what kind of data point the Fed, but also other central banks would feel comfortable enough to start cutting rates. And then there's a question on who goes first. When you analyze companies, when you look at actually what's investable around the world, are there data points that you look at to try and understand at least a first layer of what region looks more attractive?
I think the most important thing that we look at is the company's ability to sustainably grow its free cash flow over the long term. And so that's taking into account all capital expenditure. And I think that is really, that flows through to things like operating margins, but that's also really indicative of the moat of a company. And of course, the net debt to EBITDA. So we're looking for companies that have very strong balance sheets as well. And I think that if you then take that free cash flow and look out 2 years forward, if a company is trading at 4% free cash flow yield or higher, then that generally we find is a good starting point in terms of valuations.
And Justina, for you, when you look at some of the Treasury moves and some of the FX moves, of course, monetary policy will be decided on certain data points. In the U.S., is it all about the jobs after that surprise Friday number?
Yeah, I mean, it's all about the jobs. It's all about inflation. But I think another interesting thing going into this election year is, how do Americans actually feel? Because if you look at the polling, one interesting trend this year has been that despite the very robust data, I mean, a lot of Americans actually don't feel like they're necessarily a lot better off. And that can actually split according to their partisan beliefs. And I think we're definitely seeing that in the University of Michigan sentiment data, even though overall it does show that Americans are feeling a little bit better about the economy.
Hannah, over the last 4 trading days, it was also all about China, whether the economy will be stimulated enough, whether, some of the real estate crisis can be contained. How does China figure into your analysis?
I'm actually quite excited by the volatility in China. I think we've bought in positions like companies like Yum China, which are actually US listed, 100% Chinese exposure. But a company like that actually owns KFC China, for example. And the outlook for growth for a company like that, for the valuation you're getting, is phenomenal. They are looking to go from, say, 14,000 stores currently in China up to 20,000 stores over the next 2 years. So phenomenal growth in that part of the market, but exceptional balance sheet strength. Net cash on the balance sheet, very good margins. And like I said, the US listed, they've come back from around $60 to in the region of $35. I see that up about 5% earlier today. So I think a company like that, when you're willing to look outside of the US for very, very high quality businesses that are exposed to that Chinese growth story, I think you can find exceptional opportunities, but for more reasonable valuations than in some parts of the developed world.
Thank you both, Hannah and Justina. Sanlam's Hannah Gooch-Peters there and Bloomberg's Justina Lee. Now, coming up, Infineon has cut its revenue guidance for this year as the chip maker sees a slump in demand from industrial customers. That's coming up next, and this is Bloomberg. Welcome back, everyone. Now, Infineon Technologies has lowered its full-year revenue guidance this year. The German chip maker has been hit by a broader slump in semiconductor demand from industrial customers. So let's get more on this story with Bloomberg's Oliver Crook. Ollie, good morning. So take us through the numbers and what it actually tells us about the chip sector as a whole.
Yeah, Francine, overall, from the headline number, the results in the first quarter and the projections into the next one, it was basically a miss across the board here. And really what I think the focus is going to be for many people was that margin, the margin forecast. It was supposed to come in at 23.1% in the next quarter. Realistically, it's coming in at 18%. I think that was a lot of the focus in early trading, where we saw the stock down 3%. Then it went into positive territory, and then now down again about 2.5%. So the analysts kind of trying to figure out what to make of it. In terms of where it fits into the broader chip story, we see a continued narrative. It's a slowdown in the chips that go into industrial application. Where Infineon differs from many of the other chip makers is that they are really weighted towards the auto sector, which they are saying is still robust for the time being. About 50% of their revenue is in that sector. And also, of course, a third is from China. This is another thing that you have to wait to pay attention to. But they do expect a recovery in the second half of the year, so we'll watch closely for that.
Yeah, and I guess not all chip makers and chips are created equal, so it depends on where you are in the value chain. Ollie, thank you so much. Oliver Kirk there from Berlin. Coming up, our full interview with UBS Chief Executive Sergio Ermotti. We talk about share buybacks, the Credit Suisse integration, and of course, their cost-saving targets. That's coming up next, and this is Bloomberg. UBS falls after earnings disappoint investors. The Swiss bank says it will resume share buybacks this year, vowing to hand as much as $1 billion to shareholders in the second half. BP rallies after accelerating share buybacks as its new boss aims to woo investors while sticking to the company's clean energy strategy. Plus, Chinese markets soar amid promise of more support from Beijing. President Xi is set to be briefed on the country's stock slump. So good morning, everyone, and welcome to The Pulse. Today, from Zurich, I'm still Francine Lacqua, though. Let's return to our top story this hour, and UBS shares are lower after the Swiss lender missed estimates in the fourth quarter. Now, that's despite a higher-than-expected dividend and plans to increase cost-saving measures following the integration of Credit Suisse. Now, here's our full interview with the company's chief executive, Sergio Ermotti.
I'm very pleased that we finished the year with a very strong momentum. We achieved a strong underlying profitability for the second quarter, for the fourth quarter, and also we saw clients confirming their trust in our organizations. 22 billion of net new assets, strong deposit inflows across wealth management and the P&C. We made good progress in winding down part of the non-core exposures, and also that has allowed us to then also reiterate the story that we are a capital. We want to have a dividend that is increasing progressively. So we have an increase of 27% of our dividend, and also in the second half of 2024, we will do a share buyback.
How would you describe 2024? I know your chairman has said in the past that it's a difficult year.
It's a pivotal year because if you think about the journey, the first 6 months are very intense. I think we're going to go through the merger of the two operating entity, UBS and Credit Suisse AG will merge in the first half of the year. The subsidiaries in the US and Switzerland will merge also during 2024. So this is the prerequisite to be able to realize our synergies. We already achieved 4 billion of cost savings, exit rate 2023. We now plan to have another gross savings of 9 billion between 2024 and 2026. Partially, this will be reinvested in the business to make our platform more resilient and up to speed with the requirements, but also to invest in our future.
So, Sergio, how important was this investor update just to give a blueprint of the kind of growth that you want to attain and how?
I think it's very important for investors to understand how we are connecting the dots between what we said in summer last year and in respect of our long-term plans, in 2026 plans and going beyond that. So today we are providing few dots between 2024 and 2026, how we achieve cost savings, how we manage our balance sheet, how we want to manage growth that has to come in a sustainable way, and also we give also some indications about what to look forward after the completion of the restructuring, which is then going to enable us to harvest, the work, and we did with a quite attractive returns.
So how will you achieve this quality, sustainable growth?
I think that one thing that we need to do is to be willing in the next couple of years to sacrifice a little bit of top-line growth in order to improve the returns on our financial resources, particularly on the balance sheet. So I think that what we bought was a very strong business in terms of client base, very good people, very good capabilities, but the balance sheet was not properly priced. We need to price risk in a better way, and that will help us to contribute to our financial targets for 2026 and beyond.
So exactly what does that growth look like? Is it a focus on the U.S. or elsewhere?
Everywhere. I think that when you look at our wealth management business, we are planning to add around 100 million a year in terms of assets. This is basically the net numbers. We're going to want to grow more on a gross basis, but we are willing also to let some assets go that are not yielding what we believe is the appropriate level to cover for risk and capital cost. And then beyond that, we believe we're going to grow at around 200 billion. So if you think about what it is, we are recreating the business we just acquired. We acquired 700 billion of assets. In the next 3 to 4 years, we're going to build up organically the size of Credit Suisse again. So it's very important for us to do that, but in a sustainable way.
But for the U.S., for example, could we see an acquisition?
No, I think that the U.S., what we need to do is now to institutionalize our platform by giving more capabilities on deposits, on credit. We need to broaden up more of our global expertise in terms of CIO offering products, the asset management capabilities that are coming in. And what we need to do is also to allow and make it easier for our non-U.S. clients to book business in the U.S. because a lot of our global clients, they want to be also booked in the U.S. And this is a real opportunity. So we believe that by doing that, we're going to be able to narrow the gap to our competitors and setting the base for the next phase of growth.
Sergio, when you look at the, dividends and buybacks, how important was it that this was ambitious or sufficiently ambitious for shareholders?
I think is the beginning of a journey. The journey. So the fact that we are increasing our dividend by 27% is a good message of confidence. Share buyback are coming. We want to be prudent in the way we look at share buyback. We want to complete the first phase of the integration of the legal entities in 2024. But it's to give a little bit of a flavor for where we want to go. By the end of 2026, we want to exceed the levels of capital returns we had before the acquisition. So I think that it's just a testament of our confidence and our ability to generate capital as we also manage the integration.
For the investment bank of Credit Suisse, I think you were winding it down by 2/3, or this was kind of the plan. Where are we on that journey?
I think that's everything that needed to be done in terms of segregation of the non-core activities has been done. And now we have the third that we think is going to add value to the combined franchise is operating. They are ramping up their productivity. They are now part of the business, and I see a very good, promising starts. So we see we are winning mandates globally. So I'm very pleased with the momentum we see in banking.
When you look at the cost cuts, can you update us on any job losses?
There is no major changes in terms of what we were planning during the summer in terms of full-time equivalents reductions. So what we have been updating this morning is more exactly the size of the gross savings. We were talking about more than 10 billion. Now we are pretty precise on saying what it is more than 10 is 13. But as I said, it's very important to understand that we are cutting in order to create capacity to reinvest also in infrastructure and growth.
But it's impossible to exclude further job cuts, of course.
No, but it's a continuation, of course. I mean, more than 50% of our cost is headcount, and there are duplications, but we try to do it over time, also managing natural attrition and also retirements, early retirements. We do internalize much more than we had before in the combined entities. So that's also allowing us to retain many talented people across both organizations.
Bonuses. If I don't ask about bonuses, I'm going to have angry bankers email in. What can you tell us about bonuses?
Well, they already know the answer, so they don't need you to ask me the questions because we have communicated their bonuses. So,
but a good year?
I think is a year that considered both the financial performance, but also the efforts that were put into this. I'm very pleased with the efforts that our people brought into making the integration successful. They are integrating well in the culture. They see the upside momentum. So I think compensation is reflecting all of it, but it's measured and totally aligned with the UBS standards on how we pay people.
Sergio, you also have an activist shareholder who's increased, of course, their stake in UBS, Cevian. Have you had conversations? I mean, they're actually quite bullish on the UBS case, saying that you can double the share price in the next 2 to 3 years.
Oh, we are also very bullish about our future. So I think that's, I don't see anything in their investment case that deviates from our ambitions. So I think that's with the announcement of today, I think that we are also connecting a few dots with what they are looking and what we are looking, and so it's very well aligned.
Have you spoken to them?
We are always in contact with all major shareholders.
But in terms of valuations, I think that this would mean that an EU bank would match valuations of US banks. Is that possible?
Valuation is not to us to determine. Shareholders and the market will determine valuations. We will deliver results, and the market will put their own view and multiples on that.
Sergio, what kind of market are you expecting this year? Again, there's quite a lot of volatility as you know markets reprice what the Fed does, what a lot of central bank does. What do you think they're getting wrong?
Well, I think if you ask me what they're getting wrong is to pretend to know when you don't know. I mean, the truth of the matter is that the uncertainties that we see from many areas, not only the macro, more traditional economic indicator, which they seems to be much more volatile and unpredictable than we had in the past, but also the geopolitical situation, and also the emotions and the psychological effects on consumers and investors is a factor that is very, very complex to manage. I still remain convinced that the market has been too complacent early on this year about the Fed and central banks cutting so rapidly. The last mile of inflation fights seems to be more challenging. And I do think it's prudent for central banks to stay focused on fighting inflation because it creates unwanted consequences if we keep inflation way too high compared to the original targets.
And so how does that change client behavior?
For the moment, we see a little bit of clearly seasonality, and there is a concrete hope that rates will come down, but the uncertainty is still there. But we look positively for the first quarter of the year. But we do have to expect still continued volatility in the markets.
Well, that was the UBS Group Chief Executive Sergio Ermotti speaking to us here in Zurich. Now, coming up, the U.S. Secretary of State Antony Blinken continues his 5th Middle East tour since October 7th. We'll discuss what he can achieve this time. That's next, and this is Bloomberg. So the U.S. Secretary of State is due to meet the leaders of Egypt and Qatar on his 5th tour of the Middle East since the October 7th attacks on Israel. Now, Antony Blinken held talks with the Saudi Crown Prince, Mohammed bin Salman, in Riyadh yesterday as he started his tour. Now, let's bring in Bloomberg opinion columnist Mark Champion. Mark, always good to speak to you. So what will Antony Blinken actually be focused on? Is it hostages or U.S. strikes in the region?
Well, I'm sure they'll be talking about both, but the big task, the one is in the gift of the U.S. It controls the process, so it'll be mainly explaining and trying to make sure that He gets support for what the U.S. is doing in terms of hitting the Iranian-backed militias in Iraq and Syria. The other is trying to get a peace deal negotiated between Israel and Hamas. That's not in his power to do on his own. So he's really trying to rally as much support as he can. The kind of key negotiator is the Qataris, because they have a direct connection, long-standing connection with Hamas. And at the moment, the ball is sort of, as the Americans have said, the ball is in Hamas's court because the Israelis have given a proposal or a counter proposal, and we're waiting for Hamas to say what they think about that. But it's a tough, he's been very busy trying to, get some sort of, if not a solution, at least to, reduce the level of the fighting in Gaza, simply to try and prevent escalation from, spreading elsewhere in the region. And that's a tough task, and he's sort of in the thick of it now.
Mark, do you have any insight into what the relationship is between President Biden and the Prime Minister of Israel? I don't know whether there's also going to be any deterrence to really try and minimize the civilian casualties in Gaza.
Yeah, I mean, they don't have a great relationship. They have some history, and Biden is a huge supporter, lifelong supporter of Israel. And hence he came out very strongly when the attacks occurred earlier in October. But personally, he and Netanyahu are on the opposite sides of the kind of ideological fence in terms of where he thinks that how he thinks that Israel should conduct the war, how he thinks that Israel should figure out a long-term solution to the Palestinian question. They're very much on opposite sides of the fence on that. And that becomes harder and harder to manage as time goes on.
And the threat, of course, of a bigger conflict on Israel's northern border remains.
Absolutely. And that you've heard warnings. There's like a drumbeat of warnings coming from the people who really count. Like the defense minister, the chief of staff, and they've been saying very clearly there is we would like a diplomatic solution whereby Hezbollah withdraws to the line that was made in a UN Resolution 1701 back in after the 2006 invasion, the war when Israel moved into Lebanon. So there was, Hezbollah is supposed to be behind this line, which is, somewhere between, 5 and 20 kilometers, because it follows a river that kind of waves away from the border. And Israel is saying, we won't wait forever. We need for our people. There's somewhere close to 100,000 of them who've been withdrawn from around the border to safety. We won't wait forever to get them back. And in order to do that, we'll insist by force, if necessary, if we don't get a diplomatic solution, that Hezbollah does withdraw. So, you've seen, several statements like that in the last week to 2 weeks. So that is definitely a concern also.
Mark, meanwhile, billions of dollars in aid for Ukraine and Israel, hanging in the balance. What more do we know about this U.S. Senate deal?
It's looking very bad. So there was a kind of committee level agreement, and the details, were sent out. And within 24 hours, you had even Republican supporters of the deal turning against it. It seems to be because Donald Trump went onto social media saying that this would be, a disaster for the Republican Party and a terrible deal. So it seems as though the Republican, there were a number of Republicans saying that they thought that the deal was dead. It isn't yet, but it looks like it's going to be delayed for at least a few weeks. So that in itself is a problem for Ukraine, a major, major problem.
Mark, thank you so much. Mark Champion there from Bloomberg Opinion. Of course, Mark will come on to give us any updates as and when we have them. Now, BP, one of the biggest gainers on the stock 600 as fourth quarter profit beat estimates. We'll be discussing the new chief executive and his strategy next. This is Bloomberg. Now, BP, one of the biggest gainers this morning after it announced a bigger than expected buyback of shares. Now, the oil and gas major posted fourth quarter profit that exceeded estimates. Let's get more from Bloomberg's James Heron. James, thank you for joining us. So what are you reading into the accelerated share buybacks?
Well, I think the message is clear, and it's all about persuading shareholders that they can rely on BP to deliver high returns even as it transitions to low carbon energy. And this is it seems to be a direct rebuttal to some of the shareholder activism that's been happening in recent weeks, like notably Bluebell Capital, who are criticizing the company for moving too fast away from oil and gas and basically leaving money on the table as a result of that. And the message today seems to be we can give good shareholder returns and stick to our strategy.
So what can we take away about the new chief executive and actually his plans for clean energy?
Well, he was seen very much as the continuity candidate when he was nominated last month. He's definitely sticking to that, but he's being a bit more forceful in his defense of the strategy. It's not just the buybacks. He's talking today about the fact that BP will keep lowering its debt, that it's not planning any new big acquisitions. It's made a few in recent years, and now there's a period of consolidation, getting operations from them. So it's a message of sort of continuity, competence, and trying to convince investors that in the long term they can rely on BP to give good returns.
James, thank you so much. James Heron there with the very latest, of course, on BP. Now, let's take a look at some of the other top movers in today's trading session. So UBS, we've been covering it all day. In fact, that's why I'm here in Zurich. UBS will resume share buybacks this year, vowing to hand as much as $1 billion back to shareholders in the second half as it seeks to move beyond the integration of Credit Suisse. Now, we're seeing a bit of an acceleration in, of course, the share price lost, down 2.5%. Bayer suffering a blow to its efforts to finally put a lid on expensive litigation after the Germany company actually lost one of its two actions before a U.S. federal appeals court over the weed killer Roundup. Bayer down 2.3%. Then MorphoSys shares jumping after Novartis agreed to buy the German biotech company for around 2.7 billion euros. And that's, of course, adding to the drug maker's cancer treatments to its pipeline. So you keep MorphoSys gaining 3.9%, Novartis down 0.5%. Up next to Bloomberg Brief, Danny Berger and Manus Cranney in New York. They'll talk about treasuries, markets, and they'll have, of course, a full roundup of European banks, including UBS. This is Bloomberg.